If you were standing on the corner of Wall and Broad Street on the night of Sunday, October 18, 1987, the silence would have fooled you. The air was crisp, typical for New York in late autumn. The wind swept through the canyons of steel and glass, carrying the faint scent of roasting chestnuts from the street vendors and the exhaust of late-night taxis. To the casual observer, the American empire was at its zenith. We were rich. We were invincible. We had defeated inflation. We were winning the Cold War. But inside the mahogany-paneled boardrooms of the great investment banks, Salomon Brothers, Goldman Sachs, Merrill Lynch, the silence wasn't peaceful. It was heavy. It was the kind of silence that hangs in a forest right before a predator strikes. The sun does not rise in New York. In the financial world, the sun rises in the east, in Hong Kong. And on this particular Sunday night, while Manhattan slept under high thread count sheets, the sun rose over the Hang Seng Index and revealed a massacre. The market didn't just fall, it disintegrated. It shed nearly half its value in a single session. Wealth that had taken a generation to build simply evaporated into the humid air before lunch. The panic moved like a contagion, traveling west with the daylight. It hit Zurich. It hit London. The FTSE 100 in London opened and immediately began to bleed out. And then the Atlantic Ocean, the 5-hour gap. This is the most terrifying time frame in finance. The waiting. Imagine being a specialist on the floor of the NYSE. You know a tsunami has wiped out Asia and Europe. You know it is traveling across the water at the speed of the Earth's rotation. You can't stop it. You can't hide from it. You can only stand there, in your expensive suit, and wait for the wave to hit you. Why didn't they panic before the market opened? Why did thousands of traders walk into work that Monday morning, grab their coffee and step onto the floor as if they had a chance? Behavioral economists call this pluralistic ignorance. It is a cognitive glitch where a majority of group members privately reject a norm, but incorrectly assume that most others accept it and therefore go along with it. Every individual trader was terrified. Every single one of them wanted to sell everything they owned at 8 a.m. But they looked around. They saw their colleagues adjusting their ties. They saw the calm facade of the institutions. They told themselves, maybe the others know something I don't. Maybe the Americans will hold the line. Maybe the crash stops at the water's edge. They were looking for social proof in a room full of liars. Monday morning, the sky was a bruised gray. Peter Borish, the right-hand man to the legendary Paul Tudor Jones, remembers walking into his office. He didn't look at the news. He looked at the posture of the men around him. The phone started before the market even opened. This was the era before the internet took over. The telephone was the umbilical cord of capitalism. And that morning, the switchboards at the NYSE lit up like a Christmas tree. Sell orders. Sell at the open. Get me out. I don't care about the price, just sell it. There was a backlog of sell orders totaling nearly $500 million before the bell even rang. Let me describe the atmosphere of the floor. Usually it is a place of organized chaos, a bachelor party where money is the stripper. But this morning, the noise was different. It wasn't the roar of greed. It was the high-pitched chatter of uncertainty. Men were huddled in small groups, whispering. They were checking the tick, the number of stocks trading on an uptick versus a downtick. And the shoes. There was the silence of the big board, the mechanical displays that showed the prices. They were frozen on Friday's closing numbers. The ghosts of a prosperity that no longer existed. 9:30 a.m. The bell rang, and for a moment, nothing happened. There were no trades. You see, for a trade to happen, you need a buyer and a seller. That is the fundamental law of the market. But on the morning of October 19, 1987, the buyers had gone extinct. The specialists, the men whose job it is to maintain a fair and orderly market, stood at their posts, staring at stacks of paper orders to sell, piles of them, mountains of them. And there was nobody on the other side. The rational market hypothesis says that prices adjust instantly to new information. But humans are not instant. Humans are biological. We freeze, we deny, we bargain. For the first 30 minutes, the market was in a state of suspended animation, an illusion. The index didn't move because the stocks weren't opening. The specialists were delaying, praying for buyers to show up. But the buyers weren't coming. The dam was holding back an ocean of sell orders, and the concrete was beginning to crack. When the first trades finally crossed the tape, the illusion shattered. The prices weren't just lower, they were gapping. A stock that closed at $50 on Friday didn't open at $49. It opened at $42. The anchor was gone. Psychologically, traders anchor their reality to the last known price, Friday's price. When that anchor is severed, the human mind drifts into the abyss. The screaming started at 9:45 a.m. It wasn't shouting anymore. It was a roar. The roar of men watching their careers, their homes, and their identities burn to the ground in real time. Welcome to Black Monday. To understand the violence of the crash, you must first understand the seduction of the rise. Disasters do not happen in a vacuum. They are the inevitable thermodynamic correction to an excess of energy. And in the 1980s, the American financial system was not just energetic, it was inebriated. Rewind the tape 5 years. August 1982. The Dow Jones Industrial Average sat at a humble 776 points. The United States was bruising from the 1970s, a decade defined by gas lines, stagflation, and a crisis of confidence. But then the mood shifted. Paul Volcker, the chain-smoking chairman of the Federal Reserve, had broken the back of inflation. Ronald Reagan was in the White House preaching the gospel of deregulation. The bull was born. From 1982 to the summer of 1987, the market didn't just climb. It ascended. It tripled in value, piercing through 2,700 points. It was a vertical line on a graph that defied the laws of physics. For 5 glorious years, it seemed that the old rules of economics, the rules that said what goes up must come down, had been repealed by the new gods of Wall Street. This was the era of the Yuppie, the young urban professional. They were a new breed of predator, armed with MBAs and brick-sized cellular phones, wearing red suspenders as a badge of honor. They walked the streets of Manhattan with the swagger of conquerors. To them, the stock market wasn't a mechanism for capital allocation. It was a high-speed elevator that only went up. But beneath the champagne and the power lunches, a dangerous psychological pathogen was taking hold. Behavioral economists call it recency bias. The human brain is a terrible statistician. We are hardwired to give disproportionate weight to recent events while discarding historical context. When the sun shines for 5 years straight, we do not prepare for rain. We begin to believe that sunshine is the only state of nature. We forget what a storm feels like. We forget that winter exists. By 1987, an entire generation of traders had entered the market who had never seen a bear market. They had never seen a 20% drop. To them, risk was an abstract concept found in textbooks, not a physical reality. They believed in the hot hand fallacy, the erroneous belief that a person who has experienced success with a random event has a greater chance of further success in additional attempts. They believed the market was hot and therefore it could not miss. They looked at the charts and they didn't see a bubble. They saw a new paradigm. They told themselves, "It's different this time." Those are the 4 most expensive words in the English language. But it wasn't different. It was the same old story of hubris. While the Dow was reaching for the stars, the foundation of the American economy was rotting. We were living on borrowed time and borrowed money. The United States, once the world's greatest creditor, was rapidly becoming its greatest debtor. We were running what economists called the twin deficits, a massive budget deficit fueled by military spending and tax cuts, and a gaping trade deficit. We were buying Sony Walkmans and German cars, and we were paying for them with IOUs. The yield on the 30-year Treasury bond, the risk-free rate, was climbing dangerously high, hitting 10%. In a rational world, investors would look at a guaranteed 10% return from the government and sell their risky stocks. But the world was not rational. It was euphoric. The valuation of the market had detached from reality. The price-to-earnings ratios were stretching to levels not seen since 1929. But nobody wanted to hear the warnings. When you are making money with your eyes closed, the man who tells you to open them is not a prophet. He is a party pooper. So the music played on, the leverage increased, the confidence turned into arrogance. The market had become a house of cards, built on a foundation of sand, held together by nothing more than the collective belief that the music would never stop. But the thing about houses of cards is that they don't need a hurricane to knock them down. Sometimes, all they need is a whisper. To understand how a correction became a catastrophe, we have to leave Wall Street and travel 3,000 miles west to the quiet academic halls of the University of California, Berkeley. In the early 1980s, two brilliant professors, Hayne Leland and Mark Rubenstein, believed they had solved the oldest problem in finance, risk. They created a product called portfolio insurance. It sounded safe. It sounded responsible. And by October 1987, it was the most dangerous financial weapon ever invented. Here is the math that killed the market. The concept was based on the Black-Scholes option pricing model. The promise was seductive. If you managed a pension fund, let's say holding the retirement savings of 50,000 teachers, you could keep buying stocks to capture the upside, but use a computer algorithm to insure against the downside. It worked like a thermostat. If the market dropped by 3%, the computer would automatically trigger a sell order in the S&P 500 futures market to offset the loss. If it dropped another 3%, it would sell more. It was dynamic hedging. It was supposed to be a safety net. In 1980, this product did not exist. By the spring of 1986, the amount of institutional money protected by portfolio insurance was roughly $10 billion. But then the marketing machine kicked in. The professors formed a company, LOR, Leland O'Brien Rubenstein Associates. They sold this mathematical miracle to every major pension fund in America. By October 1987, the numbers were staggering: $60 billion to $90 billion. That is the specific estimate of equity assets that were programmed to be automatically sold if the market crossed a certain red line. To put that in perspective, $60 billion in 1987 is equivalent to over $160 billion today. It was a massive, silent whale lurking beneath the surface of the NYSE. The fatal flaw in their equation was a variable they called liquidity. The models assumed that you could always sell. They assumed that for every seller there is a buyer. They assumed the market was a continuous, smooth curve. They forgot that the market is not physics. The market is people, and people panic. The algorithm was designed to sell into weakness. Think about that mechanics. When prices fall, the computer sells. When the computer sells, prices fall further. When prices fall further, the computer sells more. It was a positive feedback loop, a self-reinforcing death spiral coded in Fortran. On paper, the strategy was flawless. The professors had back-tested it against historical data from the 1960s and 1970s. But they had committed the cardinal sin of statistical analysis. They assumed the future would look like the past. They had built a machine that worked perfectly in a calm sea. But they had never tested it in a hurricane, and the barometer was already falling. By late August 1987, the Dow peaked at 2,722.42. The yield on 30-year Treasury bonds had spiked from 7.5% in April to over 10% in October. The spread between stock yields and bond yields was screaming danger. Stocks were yielding less than 3% in dividends, while safe government bonds were paying 10%. The math didn't make sense anymore. The smart money started to leave the room. From October 14th to October 16th, Wednesday, Thursday, Friday, the Dow dropped by over 10%. It was the single worst three-day decline since the outbreak of World War II. This was the trigger. On Friday afternoon, October 16th, the portfolio insurance programs woke up. The algorithms calculated that the market had dropped enough to require protection. The computers began to generate sell orders, billions of dollars worth of sell orders. But here is the critical data point. The market closed before those orders could be executed. When the bell rang at 4 p.m. on Friday, the portfolio insurers were still holding a massive bag of unhedged risk. They went home for the weekend with one instruction coded into their mainframes for Monday morning: sell at any price. They didn't know it yet, but they had just programmed the end of the world. Disasters rarely arrive unannounced. They send their RSVP cards days in advance. But we are often too busy looking at our own reflections to open the mail. The crash of 1987 did not start on Monday. It started on Wednesday. If you were paying attention, the architecture of the market was already groaning under the weight of its own leverage. On the morning of Wednesday, October 14th, the Commerce Department released a single number that should have stopped every ticker on Wall Street. The U.S. trade deficit for August was $15.7 billion. The experts had predicted $13 billion. It was a miss of nearly 20%. In a rational market, this number is just data. But in a nervous market, it is an indictment. It screamed that the American consumer was addicted to foreign goods, and the only way to pay for them was to devalue the U.S. dollar. The dollar began to slide, and when the currency of a superpower slides, foreign investors, the Japanese pension funds, the German banks, get nervous. They start looking for the exit. Then came Thursday, October 15th. Politics entered the chat. Dan Rostenkowski, the powerful chairman of the House Ways and Means Committee, proposed a tax bill that was designed to kill the merger mania. It was a direct shot at the heart of the 1980s business model. It threatened to eliminate tax deductions for debt used in corporate takeovers. Suddenly, the risk arbitrageurs, the wolves of Wall Street who bet on takeovers, were staring at a loaded gun. The stocks they held were no longer gold mines. They were liabilities. They started selling. The Dow dropped 57.6 points on Thursday. It was ugly, but it was manageable. Traders loosened their ties and said, "It's just a correction. Buy the dip." Then came Friday, October 16th. The triple witching hour. The day when options and futures contracts expire simultaneously. The volatility exploded. The volume spiked. By the time the closing bell rang on Friday, the Dow Jones had plunged 108.35 points. Let me repeat that number, 108 points. Today, with the Dow at 35,000, a 100-point drop is a rounding error. But in 1987, with the Dow at 2,246, a 108-point drop was catastrophic. It was a 4.6% decline in a single day. It was the first time in history the Dow had ever fallen more than 100 points in a session. So why didn't the panic start then? Why didn't they see the cliff edge on Friday night? This brings us to one of the most dangerous cognitive traps in human history: normalcy bias. Normalcy bias is the refusal to plan for a disaster that has never happened before. It is the mental state of the person who smells smoke in a movie theater but stays in their seat because they think it's probably just burnt popcorn. On Friday evening, the traders of Wall Street went to the bars at Harry's and the Bull and Bear. They drank their scotch. They looked at the carnage of the week, a 9.5% drop in 3 days, and they rationalized it. They said, well, that's it, the correction is over. The weak hands are washed out. Monday will be a buying opportunity. They viewed the 108-point drop as the climax of the movie. They didn't realize it was just the trailer. And while they slept, the final piece of the puzzle fell into place. On Sunday morning, appearing on the talk show Meet the Press, Treasury Secretary James Baker threw a geopolitical hand grenade. Frustrated with West Germany raising its own interest rates, Baker publicly threatened to let the U.S. dollar fall even further. He was effectively telling the world, if you don't play by our rules, we will crash our own currency. It was a high-stakes game of poker played on national television. But the markets weren't in the mood for poker. They were in the mood for survival. To the Japanese investors waking up on Monday morning, Baker's words were the signal to evacuate. The U.S. government was no longer protecting the dollar. The safety net was gone. The whispers of Wednesday had become the shouting of Friday. And by Sunday night, the shouting had turned into a scream that only the dogs could hear. The stage was set. The gunpowder was dry. All it needed was a spark. Fear is a contagion. But unlike a virus, fear does not need physical contact to spread. It travels through stories. It travels through images. On the morning of Sunday, October 18th, the Wall Street Journal and the New York Times delivered a psychological weapon to the breakfast tables of every trader in America. It wasn't a headline, it was a chart. Analysts had noticed an eerie, almost supernatural correlation between the stock market of the 1920s and the stock market of the 1980s. When you superimpose the chart of the Dow Jones Industrial Average from 1920 to 1929 over the chart from 1980 to 1987, the lines were identical. The rise, the euphoria, the volatility, and then the cliff. The chart showed that if history were to repeat itself, we were standing exactly at the precipice of October 1929. This brings us to the availability heuristic. The human brain judges the probability of an event by how easily an example comes to mind. By printing that chart, the media took a remote, abstract possibility, the Great Depression, and made it vivid, immediate, and available. They primed the market for a crash. Traders looked at that chart over their coffee and felt a cold shiver of recognition. They didn't see lines on a page. They saw breadlines. They saw suicides. They saw the end of their world. It became a self-fulfilling prophecy. If everyone believes the market will crash like 1929, they will sell to avoid it. And by selling to avoid it, they caused the very crash they feared. The smart money, men like Paul Tudor Jones, had been staring at this chart for weeks. Jones had already positioned his fund to profit from the collapse. He was short, he was ready, but the rest of the herd was about to be slaughtered. By Sunday night, the ghost of 1929 wasn't just haunting the market, it was sitting in the chair. Chapter 6, The Opening Bell. The Liquidity Illusion. Monday, October 19th, 9:30 a.m. Eastern Standard Time. The bell rings. In a normal market, the bell is the start of a conversation. Buyers bid, sellers offer, and a price is found. It is a negotiation. But on this morning, there was no negotiation. There was only an ultimatum. The imbalance was so severe that many stocks simply did not open. Current rules allowed the specialists on the floor of the NYSE to delay the opening of a stock if there was too much volatility. They were frantically trying to find buyers to match the tidal wave of sell orders. So, for the first hour, the Dow Jones Industrial Average was a lie. The index is calculated based on the prices of 30 stocks. But if half of those stocks haven't traded yet, the index shows the last known price, Friday's price. This created a deadly illusion called the stale price effect. At 10 a.m., the Dow looked like it was only down a few points. It looked calm. But in Chicago, at the Mercantile Exchange, the S&P 500 futures were trading freely. And they were screaming. The futures were trading at a massive discount to the stocks in New York. This is called backwardation. Usually, the futures and the stocks move together, connected by an invisible elastic band. But on Black Monday, the elastic snapped. The futures market in Chicago was saying the market was down 10%. The stock market in New York was saying it was down 1%. Arbitrageurs, computers programmed to exploit small price differences, saw this gap and went berserk. They saw free money. They bought the cheap futures in Chicago and sold the expensive stocks in New York to capture the spread. But they didn't realize the stocks in New York weren't actually expensive. They just hadn't opened yet. When the stocks finally opened, the trap snapped shut. IBM, the blue chip of blue chips. Friday close, $135. Monday open, $124. Merck, Friday close, $187. Monday open, $165. The prices didn't slide. They teleported downward. Traders who had placed stop-loss orders, instructions to sell if a stock hit $130, watched in horror as the stock blew right past their stop price and opened at $124. Their safety nets had holes in them. Psychologically, this is where cognitive dissonance turned into panic. The reality on the screen, prices down 10 to 15% instantly, clashed violently with their belief system. Markets are efficient and safe. When the human mind cannot reconcile two opposing realities, it defaults to the most primal instinct, flight. The selling wasn't rational anymore. It was visceral. It was the frantic, clawing need to get out of a burning building, even if you have to jump out of the window. And then the machines took over. By 11 a.m., the human element of the market had largely surrendered. The traders were exhausted, their voices hoarse, their shirts soaked in sweat. But the crash was just getting started. This is the moment the machines took over. We call it the feedback loop. In 1987, computers were not the sleek, high-frequency trading algorithms we know today. They were clunky mainframes running simple, brutal logic. And on that Monday, that logic became a death sentence for the American economy. The portfolio insurance programs I mentioned earlier, the ones designed to protect pension funds, were programmed with a single non-negotiable command. If the market drops, sell futures to hedge the loss. So, as the market fell in the morning, the computers woke up. They calculated the drop and fired off sell orders into the Chicago Mercantile Exchange. Billions of dollars in futures contracts hit the pit in seconds. This crashed the price of futures. Now, remember the arbitrageurs? The men who profit from the difference between New York stocks and Chicago futures? They saw futures prices collapsing, so they did the only rational thing. They sold stocks in New York to buy the cheap futures in Chicago. This selling pressure in New York drove stock prices down further. And when stock prices went down further, the portfolio insurance computers recalculated. Their code said, "The market has dropped more. We must sell more futures." So they sold more futures, which lowered stock prices, which triggered more selling. It was a perfect automated suicide pact. Behavioral economists call this the diffusion of responsibility. When a human trader sees a market collapsing, they might hesitate. They might think, "This is irrational, I should buy." But a machine has no conscience. It has no fear. It has no hesitation. And the humans monitoring those machines? They stood back. They told themselves, "It's not my decision. It's the model. The model says sell." They abdicated their moral agency to a line of code. By 1 p.m., the market wasn't trading on fundamentals. It wasn't trading on earnings or dividends. It was trading on pure, unadulterated mechanical liquidation. The S&P 500 wasn't a measurement of value anymore. It was a speedometer on a car driving off a cliff. And then the floor gave way. There is a specific mechanism in the New York Stock Exchange called the specialist system. These are the designated market makers who are legally obligated to buy when everyone else is selling, to maintain order. But specialists are private businesses. They have finite capital. By 1:30 p.m., the specialists were drowning. They had bought millions of dollars of stock that nobody wanted. Their bank accounts were empty. Their credit lines were maxed out. So they did the unthinkable. They stopped picking up the phone. The market went no bid. Imagine trying to sell your house. You put a sign in the yard. You wait. And nobody comes. You lower the price by 50%. Nobody comes. You lower it by 90%. Silence. That is what happened to Blue Chip America. Stocks like Procter & Gamble and General Electric, companies that made actual products with actual profits, saw their stock prices falling $5, $10, $20 at a time, simply because there was literally no one on earth willing to write a check to buy them. This is where herd mentality shifts from a metaphor to a biological imperative. When the herd turns, the individual intelligence of the members drops to zero. In the wild, if you see the herd running, you don't ask why. You run. Because if you stop to analyze the data, you get eaten by the lion. On the floor of the exchange, men who had spent 30 years studying value investing threw their analysis in the trash. They weren't investing anymore. They were fleeing. By 3:30 p.m., the Dow Jones had fallen 500 points. To understand the magnitude of this, you have to look at the previous record. The worst day in the history of the market before this was in 1929, when the market fell 12.8%. On October 19, 1987, when the closing bell finally, mercifully rang at 4 p.m., the market had fallen 508 points, 22.6%. In one day, $500 billion of paper wealth, gone. It was the equivalent of the entire gross domestic product of France vanishing in 6.5 hours. The traders walked out of the building into the cool evening air of lower Manhattan. They were dazed. Many of them wandered into Trinity Church at the top of Wall Street, not to pray, but just to sit in the silence. They thought the world had ended. But the real danger wasn't the stock prices. The real danger was lurking in the plumbing of the financial system. Tuesday morning, October 20th, the day the banks died. We often focus on Monday because of the numbers. But Tuesday was the day we almost lost capitalism. When the market crashed, the brokerage firms, the guys who buy and sell stocks for you, owed billions of dollars to the banks. They needed that money to settle the trades from Monday, but their clients were broke. Their accounts were underwater. The big banks, Citibank, Bankers Trust, Chase Manhattan, looked at the brokerage firms and saw dead men walking. So the banks did what banks always do in a crisis. They pulled the credit lines. They told the brokers, no more money. This is the moment of maximum peril. If the brokers couldn't pay the exchange would close. If the exchange closed, the assets held by every pension fund, insurance company, and grandmother in America would be frozen. The economy would simply stop. It was a run on the entire financial system. This brings us to the final psychological bias: loss aversion. The banks were so afraid of losing money on bad loans that they were willing to risk the destruction of the entire system to save themselves. They were acting rationally for their own survival, but irrationally for the survival of the group. The system needed a savior. It needed a lender of last resort. Enter Alan Greenspan. He had been the chairman of the Federal Reserve for only 2 months. He had never faced a crisis. He was an objectivist, a believer in free markets. His philosophy said, "Let the bad banks fail." But facing the abyss, philosophy goes out the window. Before the market opened on Tuesday, while the brokers were staring at bankruptcy, Greenspan issued a statement. It was only 1 sentence long, but it changed the history of finance forever. The Federal Reserve, consistent with its responsibilities as the nation's central banker, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Translation: we will print as much money as it takes. Nobody goes broke today. Behind the scenes, the Fed strong-armed the banks. They told them to keep lending to the brokers, promising that the Fed would guarantee the risk. The credit flowed. The market opened. The panic subsided. But in that moment of salvation, a new danger was born. We call it moral hazard. By stepping in and guaranteeing the losses, the Federal Reserve taught the market a dangerous lesson. Go ahead, take the risk, use the leverage. If you win, you keep the profits. If you lose, the Fed will save you. The crash of 1987 didn't lead to a Great Depression. The economy kept growing. The market recovered. But the psychology of the market had fundamentally changed. The Greenspan put was born. The belief that the government would always be there to catch a falling knife. And so the traders dusted themselves off. They rewrote their algorithms. They bought new suits. And they went right back to doing exactly what they had been doing before. Because in the end, human nature is the only market variable that never changes. We forget the pain. We chase the pleasure. And we always convince ourselves that this time it will be different. When the dust settled, Washington did what Washington always does. They formed a committee. President Reagan appointed Nicholas Brady, a patrician investment banker, to lead the investigation. The Brady Commission produced a report that was remarkably clear-eyed. They concluded that the stock market in New York and the futures market in Chicago were not separate worlds. They were one single giant organism. And when one limb got gangrene, the whole body went into shock. Their solution was simple, but radical. They introduced circuit breakers. The idea was borrowed from electrical engineering. If the current gets too hot, the fuse blows, and the power cuts off before the house burns down. In the stock market, this meant that if the Dow fell by a certain percentage, say 10%, trading would simply stop. The exchange would close its doors for an hour. The logic was psychological. The regulators believe that panic is a temporary state of insanity. If you force traders to stop, take a breath, and look at the data, their rational brains will come back online. You can't panic if you can't trade. It was an admission of defeat. It was an admission that free markets are not perfectly rational, self-correcting machines. They are emotional beasts that sometimes need to be put in a cage. But while the circuit breakers fixed the mechanics, they didn't fix the soul of the market. In fact, the legacy of 1987 is not the safety mechanisms. It is the Greenspan put. By stepping in to save the banks, the Federal Reserve created a precedent. For the next 30 years, every time the market threw a tantrum, in 1998 with long-term capital management, in 2000 with the dot-com bubble, in 2008 with the housing crisis, investors expected the Fed to lower interest rates and print money. We learned that we could privatize the profits and socialize the losses. The traders of 1987 are mostly retired now, but their ghosts are still in the machine. Conclusion: the unfinished lesson. So why does Black Monday matter today? Why should a kid trading crypto on his phone or a day trader on Robinhood care about what happened nearly 40 years ago? Because the market hasn't changed. The technology has changed, yes. We don't use hand signals in a pit anymore. We use fiber optic cables and high-frequency trading algorithms that execute trades in nanoseconds. But the inputs are the same. In 1987, we had portfolio insurance. Today, we have 0 DTE options, 0 days to expiration options. These are massive bets placed by algorithms that expire in 24 hours. They create the exact same kind of hidden leverage, the same gamma traps that caused the crash of '87. In 1987, we had a 5-year bull market fueled by debt. Today, we have a bull market fueled by over a decade of near-zero interest rates. In 1987, we had the twin deficits. Today, our national debt is $34 trillion. The setup is eerily familiar. The hubris is identical. We look at 1987 and we laugh at their clunky computers and their brick phones. We think we are smarter now. We have AI. We have risk management models that are infinitely more sophisticated. But remember, the professors at Berkeley in 1987 thought they were smart too. They thought they had solved risk. The lesson of Black Monday is not about math. It is about humility. It teaches us that the financial system is not a machine that can be tuned to perfection. It is a social system. It is a collection of millions of human beings, fearful, greedy, irrational human beings, trying to predict the future. And when fear takes over, the math doesn't matter. The algorithms don't matter. The only thing that matters is the stampede. History doesn't repeat itself, but it rhymes. And if you listen closely to the market today, you can hear the faint, rhythmic ticking of 1987. The question isn't if it will happen again. The question is simply, when the music stops this time, where will you be standing?